Yeah, so thank you everyone. Good afternoon to all of you once again. And if you're joining from any other part of the world, good morning, good evening. Uh, Thank you for taking out time, for this webinar. A very warm welcome to all of you. Uh, this is our new series of webinars in this new year. So happy new year to all of you also. Uh, so in the past, PKF Singapore had, conducted multiple webinars on different topics. And this is uh, the first topic, obviously, because we have these now new recently amended guidelines for Singapore transfer pricing, which just got issued in last no the month of this 2025. So that's why this becomes the most opportune time to discuss these key amendments and changes and how it impacts different companies. Uh, so that is the whole backdrop and the context of why we wanted to have this first webinar. So thank you once again. The topic, as you would all be aware, it's the Singapore Transfer Pricing Guidelines, which is now the eighth edition. The key amendments and the practical insights. Uh, a very quick introduction about the speakers for today. This is myself. My name is Sahil, and I'm a transfer pricing director at PKF Singapore. I have around 16 years of experience uh, covering different aspects of transfer pricing, whether it's compliance, advisory, litigation. And uh, so some of you who would be joining us, on a regular basis on the webinars. So previously it was just me as one of the speakers, but now since the business is increasing and we have a lot of different work which we can proudly share about. So now I have my group presenter, my team member Grace. uh, she's a transfer pricing associate with around 6 years of experience covering both corporate tax and transfer pricing, and working upon different industries and clients. So she will also be speaking along with me, and primarily the different topics which we will be covering and the aspects are coming in the ensuing slides. So without any further ado, I'll first pass on the floor to Grace, who will kick off this webinar, and then I'll be taking forward the next of the discussion. Grace, over to you.
Okay, thank you. Okay, so what we will be covering for this webinar is we will start with what is transfer pricing as a concept and the summary of Singapore typical documentation requirements. Next, the main focus of this webinar, which is the key updates and amendments made to the 8th edition of Singapore TP guidelines and the practical implications and takeaways. And finally, the conclusion and a short Q&A session. Okay, next slide. So what is the concept of transfer pricing? Primarily, the transfer pricing refers to rules, methods, standards, and principles applied in determining the pricing of intercompany transactions, whether cross-border or domestic within related parties within a multinational enterprise group. So these transactions may include sale or purchases of goods, provision or receipt of services, borrowing or lending of funds, use or transfer of tangible and intangible assets. All these transactions are dependent on the company's business model and the industry that it operates in. Okay, so the companies that engage in intercompany or related party transactions must maintain a comprehensive and contemporaneous transfer pricing documentation on an annual and recurring basis, which is in accordance with local jurisdictional requirements. This TP documentation is prepared to substantiate, demonstrate, and validate compliance with the arm's length principle. So in a nutshell, the arm's length principle requires that a related party transaction must be made under comparable conditions and circumstances as a transaction with an independent party. Okay. So in practice, the application of arm's length principle follows a structured three-step approach. First is to conduct is to conduct comparability analysis. Second is to identify the most appropriate method and tested party. And lastly, to determine the arm's length price. Okay, moving on to the next slide. This is a summary of TP documentation requirements for the financial year 2025, which will take effect from 1st January 2025. The individual thresholds applicable for each intercompany transaction for any Singapore company are, firstly, for intercompany sales or purchases or loans, the individual threshold is 15 million per transaction. This remains unchanged from previous years. And secondly, for all the other transactions such as provision of receipt of intercompany services, management fee, royalty fee, trademark fee, license fee, and etc., the individual threshold is now 2 million per transaction. Okay. Based on these prescribed thresholds and the revenue threshold amount, we can now assess whether a company needs to prepare full-fledged transfer pricing documentation, simplified transfer pricing documentation, or no transfer pricing documentation is required at all. So when should we prepare full-fledged TP documentation is when the Singapore company's standalone entity level revenue is 10 million or more in the relevant financial year. And the intercompany transactions exceeding the prescribed threshold, which was mentioned earlier, the purchases or loans more than 15 million or services more than 2 million per transaction. And when we prepare, and simplified TP documentation is to be prepared if the Singapore company's revenue is less than Singapore dollars 10 million in the relevant financial year, but the intercompany transactions exceed the prescribed thresholds. So no TP documentation is required if the Singapore company's standalone or entity level revenue is less than 10 million Singapore dollars, and none of the intercompany transactions exceed the prescribed threshold. For these cases, only a benchmarking analysis is needed for each intercompany transaction to determine the arm's length price, as this analysis will not be subject to any threshold. Okay, so for now, I'll hand over to Sahil, who will walk us through the key updates and amendments in the 8th edition of the Singapore Transfer Pricing Guidelines. Thank you.
Yeah. Thank you, Grace. So as just Grace mentioned about the different types of transfer pricing documentation required, whether it's a full-fledged version or a simplified transfer pricing documentation, the underlying principle is that if depending upon the thresholds, if none of the thresholds are applicable for the Singapore entity from financial year 2025 onwards, because now the companies have to prepare the financial year 2025 transfer pricing documentation, wherein the deadline is November this year, November 2026. So depending upon the thresholds which she just mentioned, it has to be seen whether it will be a full-fledged version or a simplified version. And if none of the thresholds are being met and there are only related party transactions, then obviously the company doesn't need to prepare any documentation, just a benchmarking analysis is needed. But that is needed, a benchmarking analysis is needed, because that is the only basis on which one can say that the transactions are at arm's length or not. So it could be either a full version or a simplified version or no version to be prepared, but that has to be assessed on a case-to-case basis. So in that context, the key updates or the amendments made. So we have discussed the most important, which will be impacting most of the companies and their kind of transactions. So the first and foremost is the simplified TP documentation, which, just to recap once again, is to be prepared when the revenue of the Singapore entity is less than 10 million Sing dollars, but it is exceeding the threshold for the transactions. right? So in that case, previously, the simplified transfer pricing documentation, which is also called as a transfer pricing memo, it was not to be required to be dated because uh, previously the full-fledged version was to be dated by November of the financial year, uh, so as to ensure that the company has prepared the documentation on a contemporaneous basis, so that to reflect that the documentation is prepared on or before the statutory tax return filing due date, that is November. But now, uh, even the simplified version is also to be dated. So this is an important requirement because most of the times we could see that clients who had to prepare a simplified version did not prepare, or they prepared it after the due date, that is November. But there was no requirement to date it. So it could be, prepared at any certain given point of time. Obviously, the analysis was also not pertaining to the specific financial year, but of course there was no date. But now the IRAS has specifically covered this point in the 8th edition that it has to be dated, and thus if you read here, this clearly mentions that the simplified version is also will be called as is in a sense a TP documentation under section 34F. So 34F of the Singapore Income Tax Act captures the transfer pricing documentation requirements. So this is a very important element. So this means that they are now laying more focus not only on the full-fledged version but also on the simplified version. So this is the first key update from the guidelines. The second one is also quite critical, which can lead to different kind of TP audits, is disregard of an actual intercompany transaction. So the IRAS has primarily given two specific circumstances under which it will disregard an actual RPT transaction. So what it primarily means is that if the commercial or the financial relationships between the related parties are structured in this way that it leads to a potential instance of any profit erosion, base erosion, or any profit kind of a shifting situation, which has to be analyzed in very detail. Uh, that kind of a transaction can be disregarded completely. It depends upon what kind of transaction is being entered into, or where is the related party, in which jurisdiction is the related party situated in, or what kind of uh, headcount is involved, or what kind of transactions are involved. So, but if the commercial or the financial relationships are like that it is the most related parties are into tax havens or such kind of entities or such kind of countries, when there is no economic substance at all, then those kind of situations might be disregarded by the IRS. Or the other would be that there are certain transactions whose pricing policies are so complexly made that again it leads to a base erosion or a profit shifting kind of a situation. So these are primarily two specific circumstances. Of course, they are quite wide and open-ended, wherein one has to analyze in much more further detail or see as to how and what kind of circumstances are we dealing into. But primarily any kind of transaction which defeats the purpose of economic or commercial rationale, and no financial substance or no commercial substance or no economic substance, those will be definitely disregarded either by the IRS. If not disregarded, then they might reject the analysis conducted for such kind of transactions. So one has to be very careful when accurately delineating such kind of transactions before we comment that whether it is at arm's length or not. uh, Apart from this, they have also specifically mentioned about capital related transactions. So primarily that could be involving a kind of a issuance of a share capital which is primarily affecting the balance sheet of the company. So generally, uh, transactions impacting the balance sheet or capital, purely capital related transactions, are not impacted by the transfer pricing provisions. It's only the transactions which indirectly or directly or in any other way impact the P&L will be obviously impacted from a transfer pricing point of view. So, but we have seen in the past that there were certain capital asset kind of transactions, whether it's an equity share capital, or it could be a sale of a fixed assets whose the gains are maybe getting reported in the balance sheet, and some of the gains are being reported in the P&L, uh, depending upon the class of the fixed assets or any other class of the asset. So on the basis of that, they have specifically